Now, earlier when I was talking about the moving of the market or the trend, I said the market makes an impulsive move, right? And then it makes a pullback. When it makes a pullback, what did I tell you? I told you that you need to take care of this zone right here. You need to look at this zone right here. This zone is going to help you in two ways. Either when the market pushes up here, this zone will either reject the market again, right? So I'm just going to put a different color here. So the market will either reject to go to the upside. So this zone is either going to reject the market again and pushes prices to the downside. Or if this move is strong enough, it's going to break above this zone. Now, when this zone is broken, there's also two things that is going to likely happen here. The market is either going to come back into this zone, and it comes back into this zone again. This zone is either going to push prices to go up. Why is this? Because of buyers and sellers. People who took profit here, they remember this zone, and when the market comes back here, they want to sell again because they sold here and made profit, right? So they sold here and made some money. So they want to sell. So that's why they are likely going to push prices to the lower side. But then there might be a lot of buyers that bought here that will push prices to the upside. So this zone here is called an area of value. Why? Because this is an area which is likely going to push prices either to the upside or to the downside. So here the market can be pushed to the upside on this zone right here. And to prove you that this is true, let's look into this same market. All right? Clear this, right? Now, looking at this same market, I want you to look at what happened right here. So this is the example that I showed you in the previous lesson. So you can see that the market moved all the way up to this zone right here, and then it reverses. We can all agree on that, right? What happened when the market went up again into this zone? This zone rejected, and the market pushed lower. But then we have another zone here. I haven't talked about it, but here, this is the zone that I said in the previous lesson. If it is broken to the downside, this uptrend is not continuing. So now it's not broken, it's holding the market, and then it pushes prices up. When it pushes prices up, this zone is broken. And since it was trying to push prices lower here, it is now turning to the opposite side. And when the market comes back into this zone, it was a lot of movement here, but then finally the market was pushed to the upside. So this zone here is very important. This is the first strategy that I want you to master. This is the first strategy that is going to give you profits. This strategy works on any market at any given time. I have used this strategy for years. And this is the only strategy that I would recommend you to say, go put your money down, trade this strategy. But this is trading, nothing is guaranteed. An average person who goes into the market loses money. So this is not financial advice. But I've used this strategy for years. If it stops working, it might stop working in the future. But for now, this strategy is working very, very well. Right? Now, here's the thing. I want you to look into this market again, and we want to come up with another trade that looked like that. So here is what happened at this point, right? We see the market pushing to the upside right here, right? So let's do this. We see the market pushing. So once you are able to identify trends in the market, trading becomes so easy. If we look at this market right here, what is this trend, right? First of all, let's look at our moving averages, right? Our moving averages, are they fanned out? Yes. Are they moving to the same direction? Yes. Is there a gap between them? Yes. Are they in their order, right? The 21 being above, right? 21 EMA followed by the 50 and then followed by 20. Yes, it is. So are we in an uptrend? Clearly we are in an uptrend, right? So where is our point of placing a trade? Now we can look for areas of value. What is an area of value? It is a level where the market have reacted to and it is likely to react to again. So how do you identify these zones? You look back to the left. We are here. We look back to the left and we mark levels. Preferably, we want the previous level that the market touched, which was this zone in this case. But since this market moved all the way up without any reversal, we can also look at this zone. These are all the zones where the market have reacted to before, right? So looking at these two zones, the market will either come back down to this zone right here and then pulls up, or it will go all the way to this zone and pulls up. And on both zones, we are looking to place a buy trade. Why? Because we have this big impulsive move here, and we look for a pullback that comes to this zone or to this zone. Let me explain what I mean without wasting much of your time. Right? Oh, shit. So, looking into this market, let's wait and see what happened. So you can see the market comes back into this zone. When the market comes back into this zone, you can see a wick that went into this zone. This market have come into this zone. So the first thing that comes to your mind maybe is to buy here. You can also wait for a candlestick pattern for confirmation. You can wait for a green candle for confirmation. Here is a green candle that came here. So we buy, we put our stop loss, and then we have our take profit. We'll talk more about this in the near future. But then, this is what happened next. We are in a uptrend because our moving averages is confirming that we are on a level of structure. It is confirming that we are likely going to go to the upside. So the trade started with a short loss and then now it starts moving to our direction. Now, are you going to win all these trades? No, not at all. There's going to be lessons coming up on risk management, how to do your trading psychology and make sure that you are always on point, right? But then when you are able to identify these trends, it becomes so easy for you to predict the market. Why? Because the trend is your friend. We have always heard that. So if you can read the trend, if you can get these areas of value, you can be able to identify where the price is likely to go. So this trade is taking so long to play out, but then it will likely go in profits. But this is what trading does. And we can see that again, the market came back into another previous level of structure. Here, if I mark this zone, this is another level of structure. You can see the market, just to make sure that this doesn't confuse you, let's delete this. This market pushes up here, right? Pushes down, breaks up, comes back down into this zone. This is a level of structure, or this is an optimum trading zone. This is a support that is turning into resistance, right? Or this is a resistance that is turning into support. So from here, we are expecting prices to push to the upside. So this is a good place to buy, right? And you take profit here. You close or you take profit. Then we have a stop loss down below here. That's how the market works. So let's see what happens next. So the market will likely push to the upside because this is an area of value, right? So These zones are very, very important for you to understand as a trader, because the market is going to always respect the zone where it have moved to before, right? And just to make this point clear, let's delete this drawing. Oh, no. Let's delete this, and let's just to make my point clear right here, let's just delete this, and let's just mark out these levels in the market and see what is going to happen. So I'm just going to take my horizontal tool here. I'm just going to let's do a horizontal line. So so this is a zone, right? Again, we have another zone. So I just want to go back with the market, marking all these zones, and then we will look back and see if the market has been reacting to these zones before, right? So this is the zone, not the one that I marked. Okay, this is the zone. So I'm just marking the zones where the market have been reacting to before, right? And if you can see this, I'm just marking. I don't know what is going to happen below here, but let's just look back and see if the market has been reacting to these zones multiple times. Okay, look, market reacted, right? When we go back here, market reacted to the same zone. Here, market reacted to the same zone. Market reacted to the same zone. Let's go back again until we meet the market again. Market reacted to the same zone. Here it didn't touch it, but it reacted. This zone again, the market reacted. This upper zone, market reacted. This zone here, I'm talking about all these zones, right? I'm talking about, let's just remove the EMAs so that it can be neat here. Here, you can see what I'm talking about. Market reacted here, market reacted here, reacted here. It's reacting. It's the same zone, right? It's the same zone that we marked. And the market is still reacting to these zones. Let's clear this. It's still reacting to these zones. Look at this. Look at this. It's the same zone. Traders are just not patient enough to wait for the market to come back into these zones. But it's the same zones that the market have been reacting to before. Let's go back with the market. Let's see if we can meet the market again. So whenever you see a zone where the market have reacted to, look at this. This is like months later. Same zone. Right? Same freaking zones. Here. Same zone. Same zone. Same zone. Same zone. But as traders, we ignore these zones. Look at this. Same zone that the market have been reacting to. Here. Right? So you can see that if the market reacts and make a big move from a zone, just mark that zone and wait for the market to come back to that zone, and then start placing your trades when the market comes back to that zone, or look for any type of trades that you can place when the market comes back to that zone. Now, let's go back. Let's do this. Even if you do this, you are going to see what I'm talking about. You can see, if the market reacts to a zone and comes back to the zone, it will react again in the future. So how do I know the zones that are powerful that I can use, right? So since you are not going to be looking at all the zones and marking everywhere when the market have been reacting to, what I like to do is I look where the market is at right now, right? So look where the market is at, and I'm going to look for the last two zones that the market have reacted to. In this case, I have this one. This is the last zone where the market reacted to. I also have this one, right? If we had a market zone right here, the near side maybe above, I would put another zone. But in this case, we don't have. The market is in a strong uptrend. So when the market moves in the next time, I'm looking for the market to come back into any of these zones before I place any trade, right? If the market reverses, I will mark the zone that it leaves on the upside, right? For example, like this, I now have another zone right here. So these are the three zones that I'm going to be looking to place trades. Either I have three chances here, three options. Either I will wait for the market to touch this zone and then I will buy, right? Or else I will wait for the market to go down to this zone and then I can buy. Or else I will wait for the market to go and break this zone and then come back down to this zone before I buy. You see, I only buy or sell at optimum trading zones. I only buy and sell on these zones, only on these zones. If the market is not on a strong optimum zone, I'm not buying, I'm not trading that market. Because there's two reasons for this. Number one, a zone, as you saw, the market respect where it have respected before. It almost always reacts to a zone where it have reacted to before. So that gives me big chances of making money. Number two, these zones can help me with my take profits and stop losses. Remember, let's say I buy right now at this point. Let's say I place a buy trade. This zone is likely going to reject the market. So if I buy, I want prices to go to the upside. But what if prices go to the downside? That means I lose money. So I want this zone to help me to hold the prices and make sure that prices doesn't go below this zone. And since this zone have been a strong level of structure, it might actually help me with my stop loss and take profits. That's exactly why you need these zones, right? So for now, I guess that you are able to identify the trend. You are able to read the trend. Number two, you are now able to identify these zones. So to identify these zones, so before we move forward to another way of identifying levels of structure, I want you to be able to draw correct zones here. So now, as you can see, these are my zones. And for all the zones that I've drawn, you can see that I've been using rectangle tools. This rectangle tool here. Most people would love, or most, even, especially me when I was just starting out, I was using lines, right? So I would just come back and put a line right here. Now the problem with the line is, when the market come back, right? If you have a line right here, you are expecting prices to come right on the line, right? Right on the line, but it doesn't work like that. This market can come and reject and react here. It can go below the line. It can go below here. It can maybe just do this. But this is the same zone. But if you draw a line, you will never know that this is the same zone. Why? Because you are expecting prices to come into the line. But the price will not come directly into the line. It doesn't happen like that. Why? Because this is a market. This is not like where you only are going to be placing the trade. There's a lot of people, there's a lot of orders, there's a lot of brokers that are being involved. And some brokers are slower, some traders will hesitate. There's a lot of things that happen. There's $6 trillion that is being circulated in this market on average on each day, as you saw in our first lessons, right? So, first rule when drawing this, you want to make sure that your zone is big enough. I want to use a rule of thumb of saying you want your zone to be at least the size of the biggest candles of that zone. In this case, the biggest candle is this red candle here. So that's the size of my zone. If I'm drawing a zone on this point, I'm just going to use what is the biggest candle on this zone is this red candle. So I'm just going to use the size of this red candle to draw my zone. It doesn't have to be too big. Also, it doesn't have to be too small. You have to be reasonable, something like this. If I'm marking here, I'm also marking a zone which looks something like this. This is the average size of the candles, right? So When the market comes into these zones, this is where I'm looking to place my trades. These are my optimum trading zones. And in another words, you can call them support and resistance zones, but these are the zones that helps you to place your trades. Now, there's another way of identifying where the market is likely to reverse. So optimum trading zones is simply a zone where the market is likely to reverse. So the other way of doing this is using what is called a Fibonacci tool.